Stocks on Wall Street plunging on this first trading day of May, but despite the pandemic, our next guest says things are not different this time. We're joined by Rebecca Felton. She's Senior Market Strategist at RiverFront Investment Group, and she joins us from Richmond, Virginia. Welcome, Rebecca.
Thank you so much for having me.
And happy Friday to you.
Happy Friday.
Trade concerns have returned to the fore now that President Donald Trump has threatened China with new retaliatory tariffs over the health crisis. So what is this a big setback for that sharp rebound that we've seen since March 23rd? What does this mean, this next leg?
From a technical standpoint, we actually had our macro meeting this morning, and from a technical standpoint, we don't believe that the pause we're seeing is necessary and into this rally that we've witnessed coming off of those March lows. In reality, perhaps the trade concerns have been getting more airtime because I think that the president has been slipping in the polls, and perhaps this is a way to appear strong. I think the COVID press conferences have not gone as well for his image, and I think that he's trying to appear strong and a leader, and certainly the trade issues were something that helped him in the last election in terms of having a strong stance towards China.
Should investors be concerned about trade coming back to dominate headlines the way it had a year ago and it weighed over the markets?
I don't think right now that's our biggest problem. And I think that, right now the concerns we have, and we are cautiously optimistic in terms of our positioning in our portfolios, but the concerns we have is just maybe how far in advance this market is willing to discount an economic recovery. Right now, if you look at where earnings are, we're sitting at 19, 20 times forward 12-month earnings, and I think all can agree that those numbers are going to continue to come down. So investors are discounting ahead to 2021, 2022. So right now, just sort of forgetting the fact that this is a health crisis and that we still don't have a solution on that front, that keeps us cautious because that could certainly result in a step back for the market from these levels, given the rich valuations.
And Rebecca, we saw a sharp market crash since late February in just a matter of weeks, and then a sharp rebound in a matter of weeks, and then super high levels of fiscal monetary stimulus, and keep hearing these words unprecedented, unprecedented. But you say things are not different this time from other past crises. In what way?
Well, for us, it's not different just from the standpoint of relying on our process. It is, to your point, unprecedented in terms of the health crisis. There's no denying that, and the human toll can't be underestimated. But in terms of how we're positioning our portfolios and the actions that we're taking, we have been continuing to follow our tactical steps, our risk management processes. We actually started taking money out of the portfolios in terms of risk off, shifting more towards fixed income in our balance strategies, actually adding a little bit of cash in the longer horizon strategies back in late February, February 27th. Since that time, we have slowly started putting some money back to work, but we're still not fully risk on. We're still underweight equities, and in our longer horizon portfolio, still have a little bit of cash on the sideline.
And talk about stock equity allocations then. What equity reallocations would you recommend that investors make right now in the hopes of a recovery? What should they be putting their money into?
Well, what we've done is we're underweight equities, and within the equity space, we still prefer the U.S. equity market instead of the international, simply because the U.S. economy was stronger ahead of this whole market meltdown. And we do believe that our resilience and ability to bounce back is probably stronger, and the visibility around earnings when companies start giving that sort of guidance again is probably a little higher. So we have shifted towards U.S., and within that, we are leaning towards growth and quality. We've sort of lowered, we were already underweight energy. We've lowered that exposure even further, and we've shifted away from materials and a little bit away from industrials. So you've got more healthcare, technology, software services, and a little bit more staples than we have traditionally had in the last few years.
All right, so a mix of, defensive and some cyclical stocks there.
Yes.
Our growth stocks. All right, thanks a lot, Rebecca, for sharing your views with us.
Thank you.
Our thanks to Rebecca Felton of RiverFront Investment Group. I'm Fred Katayama. This is Reuters. Have a wonderful weekend.